you're not buying a property, you're investing in financial stability in the future, right? So you might believe that, oh, I'm paying something, but the house acts as a piggy bank. And a couple of things is happening. Number one, you're paying your principal payment down. Okay, if you stick here, we're gonna show you how prepaid principal payments, okay, versus most real estate professionals, they're gonna just focus on doing one essential thing. Now, listen to what I'm about to say, guys, with the knife hands. All right, I wasn't this lit. I worked out today, and I'm hungry right now because all I had was a paleo cinnamon. I don't want to buy because of the interest rate. Well, if you have the interest rate reduction refinance loan, it doesn't matter what the market does with the VA loan because the property does not have to appraise. That means that the lender can still do that interest rate reduction refinance loan, and your property value could be not where your initial finance was. So that's a real big one. Hey, let's get it. This is Anthony Glenn checking in with the SitRep Podcast, where we help you win in real estate. Today's guests, we have Bruno Nascimento and Ian Jensen, and we're talking about 10 things veterans need to know about the VA home loan benefit. Without further ado, Bruno, you want to introduce yourself?
Sure thing. Hey guys, what up? Excited to be here with you guys and share some of the expertise that we have with everybody, man.
Outstanding. And Ian, you want to introduce yourself?
Hey everybody, Ian Jensen, realtor down here in Southern California. Do work here at the Veteran Homeowners Club in Anthony, and we're here to share everything we got. So listen up.
Oh yeah,
pay you back.
I got to tell people that I'm a realtor too. So.
So this is going to be a really fun one, man. We got a lot of stuff to talk about. So make sure you hit the link and subscribe to the SitRep Podcast because we're going to be talking about everything that you need to know about the VA home loan benefit, and we're just going to spit out what we know. We're just going to rap today. Mm-hmm. This is unscripted, and we're going to start from the beginning of a veteran getting their VA home loan benefit and some things and tricks that we could talk about. We're going to talk about the concessions today. We're going to talk about the interest rate reduction refinance loan. We're going to talk about market, all types of stuff. Let's get to it, man. So let me ask a question. If you were a veteran, I'll start with you, Bruno, and then I'll just go like that. So we get.
And it just so happens that I am a veteran. Okay.
Yeah. Mm-hmm. So
Retired veteran.
Absolutely. Thank you for your service, my friend.
Thank you for your service, gentlemen.
Indeed. Thank you for my service. Thanks. But anyways, bro, a person in this market, there's a lot of fear mongering going on with the VA home loan benefit. Why would you encourage a service member to continue to purchase?
Because it ultimately sets you up for the generational wealth that we talk about, right? So why continue purchasing at times of uncertainty? Because one, it's when you can get the best deals possible, right? If you've, listen to the hype and get too caught up on, not doing something because, the market crash that's coming, that everyone keeps talking about. And it's like, man, there hasn't been a crash since the crash back in 2008, right? So everyone who's waiting to try to time the market, all you're doing is you're losing out on equity, right? And man, Ian has like a really good gist that he spits on Clubhouse when he's talking about technically you guys can't afford not to buy, right? Which is what, like, what's the thing that you say, like, whenever we're having the rooms?
Yeah, that's literally the phrase I use, because you can't afford not to buy, because on a couple different things. One of the things I say is, if say your rent is $2,000 a month, that $24,000 is gonna go away no matter what. And if you have a property and you have to pay the higher interest rate, you just suck it up. Then it's like, okay, say it's hypothetically like an extra $500 a month that you have to pay. So you just say you have to pay out that $500 a month for 3 years, right? That's $6,000 a year, $18,000 all in after 3 years before interest rates become more favorable. But if that property is, between say $400,000, that property is going to go up in value about $20,000 every year. That's about a 5% increase in value. So just that first year, you'll get that $18,000 that you're going to lose right back in your pocket. So over the long term, if you put the math together, our awesome videographer is probably going to have some great flashing
and numbers
and
all
graphics
over
here. But check it out. We got, the money you're going to lose right off the bat is your $24,000 a year. So that's $75,000 that's gone right off the bat, right away. And not to mention, So and then you got to count the money that you're not going to gain.
Exactly.
There's also something to be thinking about. People also always get this screwed up. It's not just the money you lose; it's also the money you're not earning.
What I want to do?
Yeah.
I have a great idea, guys. We're gonna break this down with you, and we're gonna go through the numbers. Okay, so we're gonna use the $500,000 purchase price, so you guys can get a good example. Or do you guys want to use 400? Which one you want to do?
500's easier math.
Okay, so let's do $400,000 purchase price.
It's easier math for Ian, not easier math for me.
I'm like straight up ASVAB waiver. I'm like the carry, the 1 and the 3 and the 7. Okay, so guys, we're going to do this real time with you so you guys get an example of what equity position looks like and then the property appreciating in value and what equity is. And the reason why we're going to do this is so you have a podcast that actually breaks down the numbers so you guys could see the benefit of purchasing with the VA home loan benefit. So Ian, do you have your phone?
Yeah.
Let's do it.
Stand by.
Okay. All right, so we're going to use this scenario right here. And Bruno, do you have your phone?
Yep.
Okay.
All right, do it real time.
All right, we're gonna utilize we're gonna use a couple of things so you guys could have this example for you all to cover. All right, so ladies and gentlemen, we're gonna do this real time with a calculator. Ian is going to be the handy dandy person using $500,000 for instructional purposes only. The median home price in the United States is around $485,000, but we rounded up just for nice round numbers for people who live in sunny Southern California. All right,
yeah.
We know in Texas that you can get a property for $10, a 9-bedroom, 38,000 square foot with horses, spears, and there, all kinds of stuff. But listen, we're using California as an example so you guys can utilize this. And we're going to use an interest rate of 6%. Okay. All right, Ian, go ahead and kick it like a sensei. Let's do it.
All right, here we go. So here's the equity that you're going to gain. So we're using a three-year time period as an example to kind of prove to you that you just have to get in and sweat it out until the interest rate's correct and you can get a more favorable rate, right? So, and the reason why we're doing this is because in the end, your equity is going to pay you back more than you're going to pay out in extra interest. So that's the big theory, and I'm going to show you the numbers why. So 500,000 times the percent increase in property value. So the average is like between 3 and 8. So we're going to pick 5, just be safe, right? So 500,000 times 5%. Boom, that's $25K.
Okay, so pause right there. So $25,000 basically means that your property appreciated over time. If I say depreciate, that's a different topic, but we're going to tie that up because depreciation can be used in your favor. And we're going to talk about that at the end of this podcast. So make sure you stay here. But your property goes up in value. That's called equity. And equity means that whatever you owe, okay, and whatever your property is worth, that sandwich is called equity. But go ahead.
Boom. All right. So we got $25K per year that you're going to gain in value by just being a homeowner. And that's not counting the amount of money that you pay it down. This is just how much your property is going to grow in value over time.
Okay.
So 25,000 times 3, boom, is 75K. So over the course of 3 years, you probably will have grown roughly about 75K on the low end. Okay. So the big picture here is that if you had to spend an extra about $500 a month to pay that extra amount in interest, that's only going to be over the course of 3 years about 18 grand, right? So what I'm trying to say is minus 18. So even if you sweat it out, you still gained 57 grand. So that's 75 grand minus 18. You still gained 57 grand in your net equity, because you always got to look at the big picture. It's not just what you're paying out. It's what you did not gain over the time. So you got to look at the big picture and zoom out and look at your entire what's the word? Net. You got to look at your entire net worth as it growing, not just what's going on in the short term, because that's what really makes a difference. And Bruno's going to go over some of the hard numbers about your facts right now.
Yeah, so that's one of the things, because a lot of times people worry about the payments, right? And that's what I tell everybody. Don't worry too much about the price. Worry about the payment. Like what it is that what you're paying monthly is what's really going to matter, especially when we're talking VA, because that can always change later by you doing the IRL that we were, going to hit on eventually here. So at a $500,000 purchase price, right, with a down payment of 0%, interest rate at 6%, property taxes at about 1.2-ish, homeowners insurance at about $1,400 a year, no HOA, So for a loan term of 30 years, you're looking at slightly above $3,600 a month. So slightly over $3,600 per month. 3,600 times 12. Okay, that's $43,000 that you will be paying down towards your principal. Or no, towards your principal and interest and everything else. But
wait a minute.
Good.
Reset.
It's that math ain't mathing. Now see, look, now you know why I gave him the calculator right now, man, because I had to take the ASVAB like 19 times to get in the Marine Corps. So this is not an Air Force podcast. This is a Marine Corps podcast, Jack. All right.
Oh, that's what we should.
But the fundamental thing, though, that I wanted to make sure that you guys picked up on is that you're not buying a property, you're investing in financial stability in the future, right? So you might believe that, oh, I'm paying something, but the house acts as a piggy bank. And a couple of things is happening. Number one, you're paying your principal payment down, okay? And if you stick here, we're gonna show you how prepaid principal payments, okay, versus most real estate professionals, they're going to just focus on doing one essential thing. Okay, so I have a hard question for you guys. Most veterans, when they're going out shopping with a real estate professional, they usually want to do a fundamental thing. Here's a scenario, all right? So real estate trivia. All right, so now Agent A is, Ian is going to be the buyer, and you're going to be the real estate professional, okay? Now you're going to be...
Here, let me bring my dad to the home.
You're going to be the Kirkland brand realtor, and then you're going to be a certified winning real estate realtor or the Veteran Homeowners Club certified realtor.
Okay.
All right. So veteran is pre-approved for $500,000. Okay. Kirkland brand realtor is taking the veteran out. He sees a property on the market for $500,000. Okay. And what does Kirkland brand 90? Now listen to what I'm about to say, guys, with the knife hands. All right. So, all right. I wasn't this lit. I worked out today and I'm hungry right now because all I had was a paleo Cinnabon. Here's the question. So what does the Kirkland brand realtor, 95% of realtors do in that scenario when they see that house on the market for 60 days?
they try to get a price reduction.
Bingo.
So, hey, if they're 500, shop for less.
Yep. Now, what would the winning real estate professional do? Because see, and realtors, if you're listening, I'm sorry that we're putting this information out there, but you guys got to get a little bit more swag on your negotiation style. What would Bruno Nascimento do for Ian?
So automatically for me, the number one thing is trying to get seller concessions. So I start shooting for concessions right there.
Concessions. Okay. And can you give me an example of, so Bruno, give me an example of what this would look like for a winning real estate professional that's actually been thoroughly vetted by the Veteran Homeowners Club to serve veterans.
So it's going to be a professional that goes and understands the power of leveraging to lower the monthly payments, right? So concessions, getting seller concessions that you can apply towards interest rate buy down. You can apply it towards closing costs, so you lower the out-of-pocket expenses, or you can take the remaining and then apply it towards paying down the principal. Bingo.
Okay. So let's unpack this. Let's give some scenarios, okay? Because I want people to see what we're talking about, okay? So agent one, I'm going to give you guys an example. I'm going to use this example because I've done it. Let me do it on my calculator right here. 500,000, okay, at an interest rate of 6.25. Okay, principal and interest is going to be $3,079 a month. Okay, now 500,000 at 5.75 with 2 points. That means 2 discount points. Would cost $10,000. Okay, and how you figure that? A discount point is calculated like this: if the loan amount is 500,000, you take $500,000 and you multiply that times 1 and then a percent sign and then equals. That would be 5,000. So 2 discount points would cost you $10,000. For this example, this is going to be a $10,000 example. The principal and interest payment on $10,000 for an interest rate buy down, your monthly payment would go from $3,079 to $2,918. That's a difference of $161 a month. Now, watch this. It would take a price reduction of $26,100 in order to meet that same monthly payment cost. So to recap, 2 points, $10,000. A $10,000 price reduction on a $500 to $490 purchase price is only going to save you like $23 a month, $24 a month, if that. Mm-hmm. Now, if you do that and buying down the interest rate and utilizing that 10 grand, okay, and keeping that 10 grand towards the actual property value staying the same and utilizing it towards buying your interest rate down, 161 savings monthly. Okay. So now if you amortize that, or if you utilize that number, let me do this math real quick. So 161 times 12, that's $1,932. Now let's just say you kept that property for 30 years times 30. That is a $57,000 savings right there. Okay. So when you're looking at these things, over time, this is a great example of why it's important to do what Bruno just said. So now that we talked about that example, so you guys have that number of utilizing that, let's go over to Ian, and I want you to talk about what buying down principal points would be. What does that look like?
Okay. So buying down your principal, this is a huge thing, and it actually can make a big difference too. So say, for instance, that scenario right there with Tony, right? Use a $500,000 purchase price. All right, we got a 30-year mortgage. So say, for instance, in that example, we're not taking the money from the seller. We're taking it out of our pocket. And we're just going to take that 10 grand and dump it onto the principal, right? So what that would do is over the term of that mortgage, right? You're going to pay about $579,000 in interest. Okay. So that's kind of the way it buffs out, unfortunately. Just the way it is. Like, you don't have to come up with your money right away, but you got to pay the piper, right? Piper being the bank. All right. So say, for instance, you took that 10 grand at the day one of owning that property. You put that 10 grand towards your principal, right? On that thing right there, you would save yourself 2.5 years, or excuse me, 18, just that 10 grand would save you 18 months of payments from your mortgage, right? So your mortgage right there is $3 grand, right? So the total interest goes from being $570,000 to $530,000. So your total interest saved would be $57,000 over the term of that loan. So does about the same. I've never actually looked at it that way. It does about the same savings. But this way, you get it paid down faster versus you get it over time with Tony's example. So it's a big play, and it can make a big, big difference in time too, because like when first it starts off, it's like you're paying more interest than you are principal, the way your mortgage works.
What's the difference
between principal and interest?
Okay, so the principal is what you owe the bank. You borrow $500,000.
Let me ask that question so it's not. Okay, so Ian, can you give us an example of the difference between principal and interest for the first-time home buyer? What is the fundamental difference?
Principal and interest are two of the things that contribute to your monthly payment. So one thing is, oh, Jesus Christ.
I'm sorry, man. Go ahead. What is the difference? What is the difference, bro?
Let me just disconnect this real quick. All right, so principal and interest, those are two things that make up two of the, damn it, what the hell? All right. So there are four things that make up your mortgage payment: principal, interest, taxes, and insurance. Hold on. All right. So anyway, so the way it starts out at first is like the bank's got to make their money back, right? So your payments are kind of offset like this, is what I say. So you're paying more interest than you are principal at the beginning, and over time they equal out so that you're paying 50-50. So if your payment's $100, you're paying $50 interest, $50 principal. And then after halfway mark, it shifts the other way, where you're paying more to the principal than you are to the interest. All right, so what this scenario does is that it gets that principal payment dropped down faster, because the interest is always calculated relative to the amount that you owe the bank. All right, so you're paying 8% a year. In your first year, you got to pay 8% on $500,000 that first year. And then the next year you pay 8% on the $490,000 that you have left. But you fast forward, then you start to say you only owe $250 left. You're only paying 8% on the $250. So that's how you can get to that point faster. And what happens is the more you put on the principal, the faster that payment gets paid down, because you get to offset the numbers.
I'm sorry, y'all. Listen, this is how we cut up. We can never get any. This is why we cannot get anything done, y'all. Basically, what he's trying to say is interest is the cost of borrowing money. And if you gave me, if I borrow $500,000 from you, okay, you would want $600,000 back, because you want to get more than what you lent out. That's how the banks make money. That's called interest. Your principal payments is the initial amount that you borrowed. So that's the fundamental difference. All right. So good job, Ian. Thank you.
Eventually.
Okay. All right. So let's
transition over to Bruno.
I can't get away from this song, dude.
Bruno, take it from here.
So, all right. So let me ask this question, Bruno. We talked about the first couple of nuggets. All right. So not lowering the purchase price of the property, so you don't become a comp. You don't want to move into a neighborhood and you just lower the property value, right? And everybody's going to know it because it's public. It's private. I like what you said about that. So if you're utilizing that towards concessions, what else can you do with concessions? And can you break down what concessions are?
Yeah. So one of the things that you can do is you can take that money and you can apply, so primarily, right, towards your closing costs. So that lowers your out-of-pocket expenses. So no matter what, you can always expect to have closing costs, right? The bulk of it will be your prepaid taxes, along with every other fee that's charged to the borrower. That's the number one thing. The next thing is going to be you taking that and then helping to pay down or pay off specific debts that you have.
Wait, hold on. So basically what you're saying is that you can get money from the seller's position to pay off your debt. Can you give me an example of that?
Yeah, absolutely. So let's say you have a specific credit card, right? And by chance, that credit card is what's keeping you from getting a better interest rate for your mortgage, because your debt to income ratio is set at a certain number. Well, you can take that money that the seller is giving you, right, through concessions, and you can apply that towards paying that off or paying that down to put you in a better position so you can qualify for a better interest rate, because your debt to income ratio is going to be better.
Oh, that's a nugget. Mm-hmm. That's a nugget. So basically what he's saying is that your Christian Mingles account can get paid off by the sellers, y'all. So you can get cash to pay off debt, and then therefore that's going to translate into lowering. Now, I do have a question. All right. Real estate trivia. Okay. What is the, what does the lender do in that situation where, the seller paid off the debt, and can the seller give cash to the buyer?
So, I mean, cash, no. So you can't get cash. You can get the funds and the credit, right? So there's a big difference. So it's not cash. You're not getting money back. You're getting a credit in the form of the seller is just, writing that you're getting a certain amount, and you can apply it towards a bill or something that the escrow company has a receipt for, that they will then go and make the payments on your behalf.
And the beauty of that is that following that, they do, lenders can do that within the transaction, because you don't have to wait for the actual reporting period for the credit bureaus. Bruno, can you unpack what that is and what it looks like?
Yeah, so they can go, they get that paid off, and then they do a rapid rescore. Is that where we're getting at, right? So they do the rapid rescore, which will ultimately say, okay, well, based off of these factors and these actions that are taken, this is what ends up happening to that qualifying FICO, therefore putting you in a better bracket for you to qualify for something better.
And guys, write this down. What if scenario lenders can do it? Or what if scenario is basically a document that the lenders can do. Now, most banks, you're not going to get this from, major banks don't have time to be doing this stuff with you. And that's the reason why it's essential to hit up smaller banks because they'll analyze your profile and see what they need to do and pinpoint specific credit situations that they could do in order to change your credit score. And what Bruno was talking about is a rapid rescore. Essentially, that takes anywhere from 7 to 10 business days. So basically what happens is that they can give you credits, right? You get the credits, the deal's paid off, right? That credit card then gets paid down. From that credit card getting paid down, they get verification letters from those creditors that lent that credit to you. That gets sent in to the 3 credit bureaus, and then from there, they rapid rescore your profile. It does cost money, and that's the reason why banks don't like to do it. But most lenders, they do have the ability to do it. But guess what? You wouldn't know that going to Federal Navy and AAUS. Now, if I disappear, y'all know what's up. All right, so Bruno, we discussed the concessions. Now you have a scenario right now about a veteran. Let's transition over to offers getting accepted, because this one is a big one. You're currently in a transaction. You just got some breaking news. Yeah. Okay, all right, fresh off the press.
Some heartbreaking news.
Can you tell us about that news real quick?
Yeah, so what ended up happening is, so we submitted an offer and it did not get accepted because, and mind you, our offer was $20,000 higher, okay? So let's put that into perspective. Somebody didn't accept it because another offer has somebody putting more money down. So they would rather go with an offer that is less, but because the other person is putting more money down, they'd rather accept that than to take an offer that is $20,000 more, because their agent did not educate them and get them on the podcast. But no, it's because the agents, man, they are not educating people on how it works. The seller, they are getting the same check in the same manner. The lender is going to go fund everything. It's all going to go to the escrow company. The escrow company is then going to wire the funds after it closes. So it doesn't make a difference if somebody's putting zero money down because they're veterans, or if they're going conventional. And a lot of times people think that conventional makes it a stronger offer, when it's absolutely not the case.
And in that circumstance, that agent just lost that person 20 grand.
Mm-hmm. And these are scenarios to where, why I don't care what anyone tells you. If I have a VA offer, a conventional offer, and an FHA offer, I'm going to take the VA loan over the conventional. And I'll give you 3 reasons why. 3 reasons why Anthonyus Glenius, the VA God, is going to accept the VA offer over FHA and conventional. Number 1, conventional borrowers can lose their job. Veterans don't. Okay. Number 2, veterans on active duty typically have good credit, right? FHA offer that appraisal sticks with the property as well, and that's the most expensive loan, and typically the barrier of entry is lower. I know with the VA, the VA requires no minimum credit score. And guess what? The default rate is lower than conventional and FHA, right? Mm-hmm. FHA is a government-backed loan, okay? There's provisions in place to protect the seller and the lender that is actually doing the loan. And then also the VA loan has the VA funding fee that backs 25% in the event that the person defaults, right? So if I look at all 3, I'm going to take the VA loan because I know how to navigate through those 3. Now, I do want to ask Ian, that's good information. Ian, I have a question for you. What is the difference between a down payment, okay, in this scenario, right? $20,000 down payment and earnest money deposit.
So let's see. Earnest money deposit is just good faith money to make sure that you don't sell the house to anybody else and it takes the house off the market.
Okay.
A down payment, that's between you and the bank. That is your collateral that the bank ensures that they are not putting out money onto a product where they could lose money on it, because that is the bank's fundamental job, is to never lose money. So what happens is they ensure that they are protected from a risk by making sure that you put at least 20% down on that property in some cases.
That's good. Down payment is paying it down, collateral, okay, skin in the game. Mm-hmm. Earnest money deposit is good faith money that takes the property off the market. But remember, there's three protection periods within the contract, And Bruno, what are they?
The investigation inspection period, the appraisal period, and the loan. So those are referred to contingencies.
And those are timelines within the contract that's going to protect you. So, and guess what, guys? In most cases, if the buyer and seller don't agree, okay, in California and majority of the states, your earnest money deposit is protected. So don't be listening to these real estate professionals. I think North Carolina is one state where there's some money that's non-refundable. But think about it. If the seller and the buyer don't agree for repairs, then they should be able to cancel. Mm-hmm. So as you're navigating through this contract, usually when a veteran is 100% financing, so why are you putting down $20,000, $30,000? And within the contract, typically there's an arbitration clause in there and a mediation clause within the residential purchase agreement, which the person is going to have to go through the court of law in order to return that money, because guess what? The Board of Real Estate can't issue funds. That is litigation. So guys, what Ian and myself and Bruno are talking about is that it is fundamentally unprofessional not to know this and to try to keep buyers in a contract when they don't want to buy. Mm-hmm. Okay. And most agents are more focused on that commission check versus actually getting you the best possible deal. Did you any one of you all want to elaborate on that?
Yeah, and I mean, and that's the thing that you see happen so often. It's that the miseducation piece or the piece that's missing, right? For that knowledge gap, which is all essentially why it is that we're doing these things. It's for us to be able to push information out there for you to, so next time that your real estate professional tells you something different, you can go and say, are you sure about that? Like, I came across a reel that said something different. Can you help unpack that, right? And then force that person to go back and then have to give you an answer and tell them to show you in writing where these things are. It wouldn't be a benefit if a veteran still had to put down the same amount of money as somebody who's using a conventional loan. It's not a benefit. It's 100% financing. So just as you mentioned, like, what is the purpose of putting more money down when it can be beneficial for you to go and reach the same goal by putting less money down? That's why it's a VA, benefit. But a lot of people don't understand it, and that's the predicament that we're in. But that's, it's the name of the game. You can't play unless you're off the bench. So stop waiting and get in there and do something.
Absolutely. And now that we talked about the administrative part and then getting offers accepted, let's transition into the power hour in less than 20 minutes. Okay. Because we only have a couple of more minutes, but I want to talk about a couple of things. Next, we're going to talk about the interest rate reduction refinance loan. We're going to talk about the VA construction loan. And then we're also going to talk about the cash out refinance. All right, so let's go to the cash out refinance portion first. Mm-hmm. Ian, can you discuss how you can leverage, what is the difference between the VA loan cash out refinance and then other traditional loan products? Okay,
cool. So let's use $100,000 as an example, right? So say I have a $100,000 property and I have it paid down to $50,000. Right, that's a 50% equity position, right? Because I own 50% of what I owe or what I bought it for. So the difference between a VA cash out refinance and a traditional cash out refinance is the fact that on a traditional cash out refinance, you have to leave at least 20% of equity in that property, meaning like 20 grand, right? Mm-hmm. So you have to you can only take 80 grand out of that thing if you had it paid off, if you had it completely paid off. It's the same $100,000 property. You could only pull out $80,000. Where that same product, that same $100,000 product, if you did a cash out refinance on a VA loan, the VA loan allows you to take 100% of the cash out of that property. So in that scenario, we don't really recommend it, full disclosure. It's risky. But you can take 100% of that cash back out of that property and pull out the full $100,000 that property is worth.
So basically what you're saying is that $500,000 property, I have it for 2 years. Mm-hmm. And with those 2 years, my property increased in value $100,000. Then I can take $100,000 out. That's correct. Now, what can I do with that $100,000? You can go buy a different investment property. That's really the big play there. Because you can still have a loan at zero down.
but now you got $100,000 into cash in your pocket that you can go and invest with, or, pay for granny's surgery or something like that, but you have the cash available.
That's cool. Or you can go get that beard implant that that you always been wanting. And okay, so the cash out refinance, how long after I get the property and I have equity position in it, how much time do I have to wait in order for me to get that money out?
Yeah, about 210 days, I believe, is what the one.
Yes, 210 days after your first mortgage payment is when you can take the equity position out. And now that leads me to your little saying that people can remember. One would get you what?
One will get you 5. All right, I like saying that one. This one's good. So, like we were saying before, on traditional loans, conventional loans, they require 20% down payment. So that means you could leverage your money by 5 times. So if you pull out $100,000, you can use that $100,000 as a down payment, and you get to borrow $500,000 that you could use for some kind of investment property.
That's tight. So now you have one property and another property. And then guys, if you make sure you click our YouTube channel, SitRep Podcast, because we're going to be also discussing how to structure your business or your VA home loan benefit to become an investor with multiple properties. So now we're going to transition over from that to the interest rate reduction refinance loan. Bruno, can you explain what the ERL is?
Yeah, so what it is, it's the ability for you to be able to lower your monthly payment by getting a lower interest rate. So it's important because you figure right now, a lot of people are talking about how their interest rates is what's ultimately stopping them from being able to purchase because they're afraid. Well, if you analyze your monthly payment, see where, get yourself somewhere where you're comfortable, buy the house, right? And then afterwards, after 210 days, you can do a refinance. As long as you are decreasing your interest rate by a minimum of 0.5%, it allows you to get into, it'll reset your mortgage. You get a lower payment. Now, you don't have to show proof of income, and you don't have to get an appraisal done. And then any of the closing costs for it rolls right into the loan. So you're not coming out of pocket at all.
And there's no income verification either, right?
Right. So that's what it says. So there's no verification of income, and you're not having to re-qualify for the loan.
And one more chicken nugget that I want to add to that portion is that the property does not have to be at value to do the interest rate reduction refinance loan. So that right there is a big one, okay? So when you are doing a refinance on any other loan, that property value has to be whatever you're refinancing it at. The interest rate reduction refinance loan is lowering your interest rate, okay? And therefore giving you the ability to have more cash flow. Okay, and then also there's something called a EEM, which is energy efficient mortgages that you can add on to that as a rider. So if you want to add solar on your property, you could do that. If you wanted to do an HVAC system, you can do that. That's called an energy efficient mortgage. Now, I do have another question in regard to the interest rate reduction refinance loan. Can you get money out of the interest rate refinance loan?
No, that would be the cash out. But for the interest rate reduction, the only thing that's happening is you're just getting a lower interest rate, which is essentially going to lower your monthly payments.
So that right there is a nugget, because a lot of people are like saying, I don't want to buy because of the interest rate. Well, if you have the interest rate reduction refinance loan, it doesn't matter what the market does with the VA loan, because the property does not have to appraise. That means that the lender can still do that interest rate reduction refinance loan, and you can be your property value could be not where your initial finance was. So that's a real big one. I wanted to talk about the VA construction loan just in nugget points. That way we can get a little highlight of what we can do. And then also we're going to end up talking about this last thing, and that's purchasing a multi-unit and how to qualify for that. Bruno, can you talk about the one-time close and explain that real quick?
Yeah, sure thing. So really what it is, it's a product that's out there it's very popular, but while it's popular, a lot of people don't know about it because not too many institutions offer it, right? So the biggest key is knowing that it's out there so you can reach out and find the people that can ultimately facilitate it. And if you don't know where to go, luckily for you, we're here to be able to point you in that right direction.
Hey, BAC, baby. Veteran homeowners club.
But yeah, but ultimately what it is, it's something that allows you to be able to go find land, right? So you find the land and you fund that. You fund the construction, and everything is rolled up into one loan right at the end. The benefits to it are that the veterans are not making any payments until that property is completely built, right? And they have attained what's called the certificate of occupancy. So this is significantly better than going the traditional or conventional route, which would then means that you're taking out 3 separate loans. The first loan would be the land loan, right? So you're going to the bank, you're having to qualify for a loan to get to go purchase the land. So that land loan alone, right, it has its own costs, its own closing costs that you're paying for out of pocket. So you purchase the land. Now you're making a mortgage payment on that land loan that you got. Now, the next part is going to be you going out, you get your plans and you get everything going, right? And then you apply for a construction loan, right? So this construction loan is what's ultimately going to go and have the builder start, financing the loan and constructing it. But now here's the kicker. Every time, right, that the builder pulls money out, you as the consumer, you are paying, you're making interest payments on the amount of money that was taken out for that builder to get through the different phases, right? Oh. Once that's all complete, right, now you go and you're going to have to do another loan, right, which is the construction to permanent loan. And again, every single loan and every single closing that you have, you're going to have closing costs associated with it. All that would then get rolled into the loan, and now you assume, the construction to permanent loan, and you start making your payments again. But this is significantly more expensive than going the VA one-time close route.
And guys, listen, so the fundamental thing too, Ian, let me ask you a question. What's happening to that property as it's getting built?
Oh, that's a good one. Okay, so what's happening to that property as it's getting built is that everything else is still going on around it. Like houses that are comparable are being bought and sold. So what's happening is even if you buy it and you build it for a certain cost, and you think that even if you took that property and you put it in place immediately, the second you buy the land, it's worth one price. By the time you're done building that house will have gone up in value. So not only are you only taking